Welcome to a journey through the psychological twists and turns of investing. Did you know that our brains are wired to respond more intensely to the fear of losing money than the joy of gaining it? It's true, and it's just one of the mind-bending facts that impact how we handle our finances. This year, as the market fluctuates with unprecedented unpredictability, understanding the psychological traps in investing becomes not just useful, but essential. From the sneaky anchor that locks your judgment to past prices, to the herd mentality that could lead you off a cliff, each chapter of this video series is designed to arm you with the knowledge to sidestep these common pitfalls. Get ready to dive deep into strategies that will not only protect your investments but also enhance your decision-making power. We'll explore why sometimes, going against the crowd or questioning a too-good-to-be-true performance can save you from financial grief. Stay tuned as we uncover the secrets to becoming a wiser, more psychologically savvy investor in 2024. Chapter 1. The Anchor Drag. Avoid getting hooked on initial prices. Have you ever noticed how the first price you hear tends to stick in your mind? That's what we call the anchoring effect. It's like when you first see a $100 sweater marked down to $50. Suddenly, $50 seems like a steal, even if $50 is the average price for a sweater. This psychological trap is especially sneaky in investing. Say you buy a stock at $100. If it drops to $80, you might refuse to sell, hoping it will bounce back to your original anchor, even if all signs say it's going down. Daniel Kahneman, a Nobel Prize-winning psychologist, highlights in his work that anchoring effects are robust, ubiquitous, and can have a significant impact on the market. Here's how you can beat this trap. Always question your first number. Maybe it's a stock price or the initial cost of a fund. Ask yourself, what's this based on? Is it really worth $100? What if you saw it at $80 first? Would you still buy it? Also, keep a journal of your investment decisions. When you write down why you bought something, you can look back and see if you were anchored or if it was a well-rounded decision. This reflection can save you from making the same mistake twice. Interesting fact: studies show that even professional traders can be swayed by arbitrary anchors. In one experiment, traders who rolled lower numbers on a dice bid significantly lower on stocks compared to those who rolled higher numbers. This shows just how deep-seated and reflexive anchoring can be. Chapter 2. Chasing Ghosts. The Peril of Following Past Performances. We've all heard the saying, past performance is not indicative of future results. Yet, how many of us heed this advice? Chasing past performance is like driving while only looking in the rearview mirror. It doesn't tell you much about the road ahead. Imagine investing in a fund just because it had stellar returns last year. Sounds reasonable, right? But here's the catch. A 5-year study of mutual fund performance concluded that funds which top the charts one year are rarely on top the next. In fact, top performers one year are more likely to fall to the bottom than stay on top. To avoid this trap, diversify your investments. Don't put all your eggs in one basket, even if that basket had a golden egg last year. Diversification helps you spread risk and capture opportunities across a broader spectrum of assets. Another strategy is to look for consistency rather than peak performance. A fund that shows steady returns over a long period is often a safer bet than one that spikes suddenly. This approach favors the tortoise over the hare, focusing on long-term growth rather than short-term gains. Here's a compelling piece of advice from Warren Buffett. The stock market is designed to transfer money from the active to the patient. This reminds us that patience, rather than reactive moves, often pays off in investing. By understanding these traps and how to sidestep them, you're setting yourself up for smarter, more effective investing. Remember, it's not just about growing wealth, but also about protecting it from common pitfalls that trip up even the savviest investors. Chapter 3. Confirmation Conundrum. Breaking free from the echo chamber. Ever find yourself only listening to news that agrees with your views? That's the confirmation bias at work, and it's a big problem in investing too. When we pick stocks or investments, there's a temptation to only acknowledge information that confirms our choices, ignoring the red flags waving at us. One effective strategy to break this bias is to actively seek contradictory information. For instance, if you're considering buying shares in a company, spend time researching reasons why you shouldn't. It might feel odd, but this helps you see the full picture. Try creating a devil's advocate group among your investment friends or advisors. Their job? To challenge your investment decisions. This can be an eye-opener and can prevent costly mistakes. According to psychologist Daniel Kahneman, seeking opposing views is the only antidote to the confirmation bias. Another tip is to regularly review the reasons behind your investment choices. Ask yourself, what would have to change for me to reconsider this decision? This question can guide you to reconsider your stance when significant new evidence appears. A surprising statistic reveals that investors who regularly expose themselves to differing viewpoints tend to outperform those who don't by up to 7% annually. This shows the power of balanced information in making robust investment decisions. Chapter 4. The Herd Hurdle, Evading the Investor Stampede. It's easy to follow the crowd. After all, there's safety in numbers, right? Not always, especially in investing. The herd mentality can lead to inflated asset bubbles and sudden market crashes. Remember the dot-com bubble or the housing crash? Lots of investors got burned following the crowd. To steer clear of the herd, focus on your own financial goals and risk tolerance. What works for others may not work for you. Personalize your investment strategy instead of copying what's trendy. This approach ensures your investments align more closely with your long-term objectives. Another tactic is to practice contrarian investing. This means going against the current market trends. When others are buying, it might be a good time to sell, and vice versa. Legendary investor Warren Buffett advises, be fearful when others are greedy, and greedy when others are fearful. Lastly, keep a close eye on investment fundamentals. No matter how many people are buying into a craze, if the fundamentals, like company earnings, market conditions, don't support it, it's risky. By sticking to fundamental analysis, you can avoid getting swept up in market manias that don't end well. In one study, investors who resisted the urge to follow the crowd during market downturns preserved their capital better and recovered quicker than those who panicked and sold off. This resilience is key in navigating the volatile waters of stock markets. Chapter 5. Loss Aversion Labyrinth, Navigating the Fear of Falling. It's a well-known fact that for many, the pain of losing is much more intense than the joy of gaining. This phenomenon, known as loss aversion, can make investors hold on to losing stocks too long, hoping to break even rather than cutting losses and moving on. But here's how you can tackle this tricky trap. Firstly, set clear exit rules for your investments before you even buy. Decide the conditions under which you'll sell a stock, whether it's a certain drop in price or a change in the company's fundamentals. This pre-planning reduces the emotional pain of decision-making when the market is volatile. Another strategy is to regularly rebalance your portfolio. This means adjusting the weights of different assets to maintain your desired level of risk. It's a method that naturally involves selling off some winners and buying more of the losers, countering the urge to cling to losing stocks due to fear. Here's a striking statistic. Research has shown that investors who overcame loss aversion and rebalanced their portfolios outperformed those who didn't by 4% per year. Clearly, managing your psychological biases can lead to better financial outcomes. Chapter 6. Optimism Overload, Managing Overconfidence. Overconfidence can be a double-edged sword in investing. While it's great to have confidence in your investment decisions, too much can lead to underestimated risks and overlooked opportunities. Here's how to keep your confidence in check. Start by conducting thorough research. Never invest based on a hunch or a tip. Instead, gather as much data as you can about the investment and ensure your decisions are well informed. This approach helps temper optimism with a healthy dose of reality. Implement a strategy of seeking second opinions. Before finalizing an investment decision, consult with others, perhaps a financial advisor or an investment-savvy friend. This can provide new perspectives and may highlight risks you hadn't considered. Interestingly, a study showed that investors who believed they were less skilled than their peers actually made more money. This humility helped them avoid the pitfalls of overconfidence, leading to more cautious and deliberate investment choices. By understanding these psychological traps and employing strategies to avoid them, you set yourself up for a more disciplined and successful investment journey. It's not just about choosing the right stocks, but also about setting the right mindset to navigate through the ups and downs of the market effectively.